Joining us now, Beyond Sport Global Ambassador, Fox News contributor, my dear friend John Layfield. John, your expectations for earnings going into this week?
I think we're going to have another great earnings season. The last earnings season that we had was the best earnings beat in 25 years, since the early 1990s. We're seeing so far a third of the S&P 500 companies have reported. 87% have had earnings expectations, had an upside on those earnings estimates that they've had. So it's going to be interesting to see what we're going to see this earnings, especially when you have the automakers reporting this week. You have GM and Ford, which I own both, reporting. They've already had commodity inflation problems. It's going to be interesting to see how well they're hedged for these tariffs going forward and how these tariffs are going to affect projections going forward.
Lindsay, some other companies to watch are these industrial companies. I think Whirlpool, Harley-Davidson are two of the names out with earnings this week. We will be listening for those, even 3M listening for the impact of the steel and aluminum tariffs and any kind of supply chain disruption these companies are experiencing.
Absolutely. We're seeing these companies, 94% of the industrial companies that have reported have beat on both the top and the bottom line. The stocks are reacting really well. The question, John, is I don't know if you have a thought on this. It feels like the question is, are orders being pulled forward? Is the second quarter coming in significantly better than expected because people are trying to get ahead of the tariffs and that's what's causing raised guidance for the full year? Or are we just doing better than we thought?
That's a great question, Lindsay, and it's a little bit of both. We are seeing earnings pulled forward, people getting around these tariffs. So you're seeing a lot of stuff shipped early because of this, but you are seeing better than expected. We're going to have a 4% GDP. That's going to be a little inflated because people are getting these orders out there ahead of these tariffs. The earnings season this year, I mean, this is the dichotomy of this administration. We're going to have 20% earnings gain this quarter. About 35 to 40% of that comes from these tax cuts. So the administration has done a great job in spurring this economy that's already long in the tooth in this bull market to revitalization. The problem is all 100% now black cloud is these tariffs and what can happen if a potential trade war happens. It could negate everything that happens with these tax cuts.
But so far, John, it looks like the markets are giving the White House, giving the administration some breathing room on this. How long do you think that can last? I mean, to your point, we're going to get guidance this week from some major industrial companies, the automakers, about any potential fallout.
I think it starts until it starts significantly hurting. You know, it's easy when you talk about a potential trade war. We're actually in a trade war right now. No matter what level of that trade war we're in, we're actually in one right now. You look at Tampa Bay, Pittsburgh, Salt Lake, they're all reducing headcount right now in their newspaper business because of the tariffs that we have on Canadian paper. So you're starting to see problems right now. You see soybeans, you see the livestock right now, you see a glut of that going on because we have two problems. We had a huge amount of livestock produced this year, and we also have these tariffs that are coming on, so we have a glut. Until you start seeing these Americans start being hurt, which I think we're going to start seeing, I think you give the president a pass on this. This is negotiation, but this is sticking a match next to gasoline saying, hey, I'm going to blow up everything if you don't agree. It is a dangerous, dangerous game we're playing right now.
John, how do you structure a portfolio around that? Like, because again, you're not getting paid that much to own fixed income here. How do you allocate money?
I think dividend stocks have become the de facto bonds like they have been for the past several years. I know interest rates are rising, but that's still the play. Look, you have problems in the EU. If England drops out of the EU, which it looks like they're probably going to do with probably a hard Brexit, that takes out a huge amount of fees going to the EU. The EU looks like it could break up, especially if you start losing to smaller players like Italy and somebody else follows. You look at the problems in China right now. The U.S. stock market is still the place to be, and I think dividend stocks are going to be the safe play going forward because I don't think people know what's going to happen with this market. This market should be significantly higher. This economy is absolutely on fire. The only black cloud right now are these trade tariffs, and that's why I would stay with dividend stocks.
I'll say this, the head of the European Commission, Jean-Claude Juncker, is going to be at the White House on Wednesday. Maybe you get some positive developments out of that meeting. You never know.
He doesn't have high expectations, according to the people around him. But you're right. We could have a big upside surprise come out of that. I wouldn't be surprised if the EU says, you know what, we're just going to drop the 10% tariffs on cars and then see what the president does. Because if it's really about those tariffs, then the president will drop it, and this trade war could end, at least with our friends Europe. The problem we have with Europe right now is they're now negotiating deals with our trading partners that are our neighbors in Canada and Mexico. This could be long-term structural damage if we don't get in front of this right now and try to work out something with Mr. Juncker when he visits this week.